In the past few decades, the European economy has fallen behind. Whilst the US economy booms, Europe struggles to avoid recession.
Germany is in recession.
The Eurozone slipped into technical recession in the first 3 months of the year.
The numbers are stark. In 2008, the EU was 90% the size of the US economy. Today it is 65%. As a share of world GDP, Europe is declining, overtaken by China and in the future perhaps India. The euro has already fallen 33% in the past decade as investors become more pessimistic. But could this gradual decline risk becoming a sudden hard landing of irrelevance? We shall look at the role of austerity, the Ukraine war and an ageing population, but also find out why economic statistics can give a misleading impression. During the 1980s and 90s, the EU made great progress, with the single market helping to reduce barriers to trade. The EU was a model of stability and economic growth, helped in no small part by the post-war German economic miracle. But in recent years, this has come unstuck. COVID and surging gas prices saw the single market fraying at the edges. But the Nobel Prize-winning economist Paul Krugman argues that one of the biggest barriers to growth in Europe has been an obsession with reducing debt, especially in Germany. Since the euro debt crisis of 2010, the EU has prioritised reducing fiscal deficits, which has led to lower economic growth. But an unfortunate consequence of austerity has been a failure to reduce debt to GDP ratios anyway. Italy's debt has soared, despite efforts to reduce borrowing. This is because slower economic growth leads to lower tax revenue, which leads to rising budget deficits and more pressure for austerity. Europe has become stuck in a cycle of low growth, low confidence and austerity. Italy is symbolic of Europe's economic stagnation, with one of the worst wage growth rates in the world. Austerity is not the only cause of Italy's woes, but it has hardly helped, and the recent rise in interest rates is particularly bad timing for all of Europe. The effects of austerity and weak economic growth have been magnified by long-term demographic factors. The European population is ageing fast, and this is slowing down investment and productivity growth. In previous decades, the ageing population could be offset by increasing female labour market participation and relatively high levels of migration. But a populist backlash to migration means that this can no longer be relied on, and Europe is ageing at a faster rate than ever before. Europe has a chronically low birth rate, and with housing costs going through the roof, there's going to be no easy solution to this. One of the impacts of an ageing population is that firms have begun to hoard labour, even if not particularly productive. It is a similar situation to which we saw in Japan in the past few decades. Another problem of an ageing population is that it puts further pressure on government spending. European economies already pay a very high share of GDP on pensions, but the demographic pressures we see is only going to put more pressure to raise tax or cut public sector investment. Now, when talking about European economic decline, it is important to bear in mind the impact is very varied across the continent. The biggest losers in recent years have been Germany, Italy and Greece. By comparison, eastern countries like Poland and northern countries like Ireland have been doing really quite well. The biggest driver, though, of the European economy in the post-war period was Germany, and it is Germany's economic slowdown which is most worrying. German industries in particular complain about a burden of regulation. The Economist report it takes 120 days for a German firm to receive an operating licence. Italy and Greece, hardly bastions of free enterprise, take 40 days. Construction permits take 50% longer than the OECD average, and the German adoption of digital services lags behind the rest of the world. 5G adoption is much lower in Europe than the rest of the world. Even the once mighty German car industry has struggled from Brexit, but more importantly, increased competition from the Chinese electric vehicle market, which has been growing very well. Europe has so far largely missed the boat on big tech and artificial intelligence. The global growth sector has been dominated by the US and Asia. European firms seem to lack a flexibility and nimbleness to jump into these new areas of growth. The EU have sought to take on big tech with policies like GDPR, but this is another example of a regulatory burden which has placed costs on business, especially small and medium-sized firms, and not the big tech giants, which was the goal of the regulation. The old German growth model of relying on regional banks and federal regulation is falling behind in the new age of AI, startups and the digital revolution. And it doesn't help that in the past decades, Germany made the fateful decision to give up nuclear power and rely on cheap Russian gas. The shock rise in gas prices in 2022 was very damaging for both German industry and the wider European economy. In fact, given the inflationary shock of higher gas and oil prices, the European economy has perhaps done less badly than many feared. A key factor has ironically been all the imported liquid natural gas from the US. But a transition to a green economy and energy independence that doesn't rely on foreign dictatorships will be difficult and expensive for Europe, Germany in particular. In the US, the recent inflation was mainly due to a strong economy and rising demand. But in Europe, it was mainly due to rising energy prices, which is why Europe ended up with the worst of both worlds, high inflation and falling growth. On a more optimistic note, you could say that the recent geopolitical shocks will potentially help European firms as firms look to bring production closer back to Europe and away from relying on China and other Asian countries. However, Europe is struggling to compete with the US when it comes to industrial subsidies for green technologies. In the US, President Biden's ambitious program of subsidies for renewables led to a surge in American growth and investment in manufacturing. And this has given American firms, perhaps unfairly, a large competitive advantage. The EU, by comparison, has found it harder to create such an ambitious spending programs when it's difficult to find agreement amongst the member states. What about the euro? Is the European Union's bold experiment with a single currency actually leading to lower growth? Initially, when the euro was adopted, it led to a wave of euphoria as consumers and firms enjoyed frictionless trade and consumption. In the euro, countries in the south borrowed to fund consumption from the north. But this initial euphoria masked a growing divergence, with southern economies becoming uncompetitive and running large deficits. When the global credit crisis hit, the Eurozone was plunged into crisis, with bond yields surging as markets worried about debt levels. Now some European countries like Spain and Ireland have bounced back from this crisis, but countries like Greece and Italy have been hard hit by a decade of austerity. The crisis highlighted the difficulty of having a single currency and single monetary policy over such a wide, divergent area. Since 2008, the euro has highlighting the decline of prospects for the European economy. It reflects a fall in economic growth and a stagnation of economic prospects. Now, it is important to bear in mind that the problems faced by Europe are not unique. Japan, the US, and even China have all seen slowdowns in economic growth compared to previous decades. The post-war period was a unique opportunity, with transforming technologies like computers, internet, microchips, containers, a rise in labour market participation, the baby boomer generation, strong confidence. And many of these advantages are just no more, and so growth becomes harder for everybody. But it does seem that Europe has struggled much more than, say, America. Now, whilst it is true that the European economy has definitely struggled compared to America, it is important to bear in mind a bigger picture. Firstly, US has a higher GDP per capita, but it is also true that the US works 15% longer hours. In the case of Germany, Americans work 35% more hours per year. Some of this reflects longer paid holidays that European workers can enjoy. The EU mandates a minimum of 20 days paid leave per year, The US has a federal minimum of 0. American workers may be better paid, but many long for some of the benefits and greater leisure time that European workers enjoy. And you might add healthcare as well. Also, the 50% decline in the euro means that comparing Europe to US in dollar terms needs careful evaluation. In dollar terms, EU productivity has fallen behind the US. But if we use purchasing power parity, which takes into account local prices, EU productivity has actually exceeded the US. And going back to the first comparison of economic growth, if we use purchasing power parity rather than dollar terms, the relative difference in performance is not quite as bad, although it's important to stress Europe is still growing slower than America, whichever method you use. And nevertheless, the weak growth of the European Union is a significant problem, and one that is increasingly recognised by both firms and politicians. But whilst it's easy to recognise and diagnose a problem, doing something about it is much more difficult. In particular, the demographic challenge is a real problem for Europe because it is so acute and has so many potential problems. This video looks into more detail on how Europe will be changed by a rapidly ageing population. If you enjoyed this video, please give it a thumbs up and do subscribe to the channel.